So Donald Trump's plan to crash the global stock markets has just created some of the most catastrophic price downturns that we've seen since the 1987 crash. And today we're going to be showing you 9 different charts that help to illustrate not only just how crazy the stock market crash has been, but we're also going to be looking at some charts that help to explain when the Fed might pivot, because everybody knows it has been part of Donald Trump's plan to crash the markets and get Jerome Powell to finally lower interest rates. And the data we're going to be sharing today suggests that maybe the Powell pivot could be close and the money printers could be about to be turned on globally. And we all know what Bitcoin does when the money printers get turned on. So Rob, I want to get your thoughts on the carnage that we've seen in the stock markets over the past week.
Boomers are losing their minds, Luke. They're pulling out their hair. They thought they could sit back nice and pretty and just let this Biden economy just rocket them into the future. But no, we have a hard dose of reality. We are down, 20+% on the major indices over here in America. And I don't think we're done yet. This is one of the most gnarly stock market falls that we've seen, of course, since COVID. That was 5 years ago now. And yeah, this is only just getting started. This story is far from done from being played out. And the thesis that you laid out in the beginning was what people thought what was going on before this, that Trump wanted to bring the markets down back to earth to bring interest rates down and thus help the average person, help Main Street, and let Wall Street take their medicine. However, as I'll divulge in not too long, I think that there might be something else going on here.
Ooh, spicy take, Rob. We're definitely going to dive into that here in a moment. But I wanted to firstly show this chart of this kind of illustrates what you're talking about. Boomers are in disbelief. So this chart here shows that the top 1% own 54% of the stock market, and the top 10% own 93% of the stock market. Those very, very little tiny slivers of yellow and green make up the bottom 40% of society, and the middle class, that is the yellow sliver. And then the upper middle class is represented by, again, the very small sliver of bright blue. And we can see typically the top 1% and the top 19%, this is the boomers. This is the tech billionaires. This is those who have been in the markets for the past 50 to 70 years. And these are the guys who are right now most affected by the stock market crash.
Yeah, so I mean, 63% of Americans own stocks, but it's really only the top 20% who own a meaningful amount of them, right? That top 20% owns about 80% of the value of all the stocks in America. So by losing 20% of these stock market values, you're hurting that top 1%. You're hurting that upper middle, upper class here in America. So, but I mean, that's not really the base that got Trump elected, right? It was the people in the Rust Belt, people in the middle of America who have been forgotten, who have seen the factories close down and their hometowns turn to fentanyl dens, really, right? I mean, there's a lot of problems here in the economy in America, despite the fact that we have all-time highs in the stock market up before this week. There's a lot of things that need to be addressed, and it seems as if Trump is taking these things head on. It takes a lot of guts and balls, just frankly, to do such a thing. But we'll see. We'll see if his plan is working out. I mean, people thought that this, by tanking the stock market up to 20%, would bring down the 10-year. The 10-year bond, the interest rate on that is really what determines the price of money around the world, whether you're looking to get a mortgage here in America or to buy a car, to lease it out. I mean, the interest rate you get is a derivative of that 10-year rate. So With the 10-year, it crashed. It was about 4.5% before all this tariffs, and then it crashed down to as low as 3.8. But now we're back up to 4.2. So despite all the carnage in the stock market, as you can see, that last bar there where it's gone straight up, shows that, yeah, this plan is not working accordingly as many people thought was Trump's initial goal. But yeah, what do you think?
Sorry to cut you off. I'm blaming the dodgy Peruvian Wi-Fi on that one. I apologize. But yeah, I think it's a great point you make there about the 10-year yield. So this is what we're looking at here. So we can see that the COVID crash kind of marked a little bit of a trend change, so to say, in the 10-year yield. When you zoom out, since the 1980s, this thing has only been really trending down. Okay, this means more and more people have been buying bonds. This has been the bond bubble. Everybody's bought into the ideology that the 60-40 portfolio is something that worked. Everybody thought they needed 40% of their portfolio in bonds because so-called smart people like Dalio said that that was what was needed. And 2020 kind of it looked like it marked a little bit of a trend change. So again, I always like to start with the bigger picture. And it kind of looks as if we're in an era of people selling bonds off. So when this chart is rising, that means yields on bonds are rising because people are selling the bonds.
Yeah, great point to mark there, that we had a 40-year bull market in bonds, and that means that the yield is going down, right? That's actually a bull market is what you're seeing there, 40 plus year one, from when Volcker raised rates up to near 20% in the early 80s to kill the inflation of the 1970s when we got off the gold standard and transitioned to the petrodollar. So they were able to rocket rates up to close to 20%, but that's of course only doable when your debt to GDP was back then around 30%. Today, it is well above 115, close to 120%. So we're in a very different world than we were back then. But this last, yes, as you said, COVID marked the absolute top in bonds, right? The price of money was ridiculously cheap. You could lend for close to next to nothing, right? Close to 0%. But since then, they printed $6 trillion in 18 months, right? They created 40% of all dollars in a year and a half. And people said, wow, okay, well, if I'm going to lend you this money, you got to pay me back more than 0%. So we've seen the rates on the 10-year go up. And as I mentioned previously, this really dictates the price of money for the whole entire world. And so the idea was that if we crash the markets, then we could get this, people would go into bonds, and of course the yields would come back down, and it would make it easier for the average person to go out and get a mortgage to buy a house, because the mortgage market in America has pretty much frozen with the prices as high as they are post-COVID, and now rates as high as they are. If you buy a $500,000 house and you're spending 67% on interest, that means you're going to be spending $1 million after the course of the 30 years in order to get that house, with of course half of it going just straight to the bank, right? So but this plan, it doesn't seem to be working out. So that's why I think something else is actually going on here.
Yeah, that's really interesting. I think we are going to definitely get back into this potential plan that Donald Trump is talking about. We're not going to stare at charts for 25 minutes, we promise you. But we do have one more quick chart that I think helps to explain the carnage seen in the bond market in a little bit of an easier way. So this is the US TLT 20-year bond. So this is just looking at the price of the bond. We're not mucking around with yields. When this thing's going up, that means bonds are being bought. So you can see for 20 years, between 2003 and 2020, what happened? This chart went up, people were buying bonds. But have a look at the destruction we've seen since 2020. TLT is down by 51% since 2020. This has been US 10-year and US 20-year bonds. This has been the savings vehicle for central banks all around the world. They haven't been buying gold, they've been buying government debt. So I think this just really goes to show just how much has changed in the past 3 years and why I think old models should be considered very, very carefully, because I feel like the data has changed. Rob, speaking of data, do you want to start breaking down all the charts we have in this little website here that I thought was pretty cool? Or do you want to dive a little bit further into this Trump plan? Because I'm genuinely curious to know what you think about it all, because we actually haven't compared notes before this stream.
No, we haven't. Let's leave it. Let's build some more suspense. Let's talk about the carnage and what we saw.
Let's do it. So this chart right here, this is looking at the 2-day drops in the S&P 500. And what we've seen is that the S&P 500 is down by more than 10% in 2 days. And we haven't seen a crash this big since there's a big one there in the 1990s. I believe that would be the 1987 stock market crash. That's known as Black Monday. And the big, scary looking candle we're printing right now, it's in the top 4 biggest 2-day crashes in history. It's huge. The carnage we're seeing is massive. This is why we're seeing volatility spike. So this chart here is measuring 2 different types of volatility. In the blue, it's measuring the volatility in the European markets. And then in the red, it's also measuring the volatility in the American markets. Both absolutely soaring. Now, another really cool chart is looking at the European banks. So they have just suffered their 4th biggest 3-day crash on record. This is the biggest ever. There is no competition. You can see the crash that we're seeing right now. It's bigger than 2020. It's bigger than any crash we saw in 2008. It's also bigger than any crash that the European stocks saw in the 2000 technology bubble stock crash. You can see a lot of volatility around that year 2000. And then this big crash here, I'm assuming this is the 1987 stock market crash. What we're seeing right now in Europe is massive. It's big. It's in the top 5 biggest crashes in history. It's crazy. But now the more interesting chart that I want to show you has to kind of do with, the bigger idea of what's going on here. What is the Fed going to do with interest rates? Is Trump trying to force the Fed to cut interest rates? I think that's what Rob and I are going to discuss here. But what I do think is interesting is that in literally 5 days, have a look at how much has changed. So a lot of the carnage has happened in the past 2 days, 3 days, 4 days, and 5 days. And in the yellow, what we're looking at on this chart is the probability of the Federal Reserve, the ECB, and the Bank of England. What we're looking at in the yellow is their probabilities, or what they were saying they were going to do with rate cuts in the future. And there you can see in the pink lines, in the pink bars, this is the updated projections on what central banks plan to do. We can see much bigger rate cuts in the pink bars. And this just shows how much has changed in just 5 days, which is pretty crazy. What do you think of all these charts here, Rob?
Yeah, the liquidity is coming, right? Things are definitely tightening up. People are getting scared, and at the end of the day, we are on a fiat standard in this world. And so when they've got all they have is a hammer, so every problem looks like a nail. So when things get bad enough, they're always going to print. And lowering interest rates, cutting interest rates is definitely one of the main tools that they use to get more liquidity into the system. So yeah, I mean, a lot of things have changed in just the last week. But it's funny because, I mean, Trump campaigned on this, right? He made it clear for months on end that he is going to balance things out by unleashing tariffs. And it seems as if, I mean, when he first got elected, the markets just soared. Everybody thought this was going to be the most business-friendly administration in the history of the world. They were going to deregulate everything and just let businesses go wild. But it does seem as if Trump, especially in his older years now, right? He's pushing 80. He sees this as his last opportunity to really make a lasting change and rebalance these trade deals and the flow of trade around the world.
Yeah. there's certainly going to be a lot of reordering when it comes to global trade around the world. There's this tariffs battle only seems to be escalating. But you did mention something else there, Rob, about global liquidity.
Now, before I show you the rest of this rabbit hole, just want to remind you guys, if you wanted to join in on the fun and also buy some Bitcoin, we always encourage you guys to check out what Rhino Bitcoin is doing. We call them the all-in-one Bitcoin super application for very good reason. They're the best place for you guys to buy your Bitcoin, but you can also sell Bitcoin on Rhino. You can send Bitcoin anywhere around the world using the Lightning Network on Rhino, and they're even giving you guys $10 of free Bitcoin if you sign up with Rhino and use a promo code Bitcoin News. So we always encourage you guys to check out what Rhino is doing.
Now, I love this chart here. It's one of my favorite charts. Now, what it's showing us is in every Bitcoin bull run, global liquidity typically expands. So we can see in the bottom part of the chart in the blue, we're looking at global liquidity. And those two big red circles is highlighting the big spikes that we saw in global liquidity during the 2017 Bitcoin bull run and the 2020 Bitcoin bull run. So we can see how much and how aggressively global liquidity got expanded. Depending upon how you measure it, I like to look at a different measurement, and it shows that in 2013, Bitcoin's biggest bull run, liquidity got expanded by 22%, Bitcoin rallied by 100x. So 22% global liquidity expansion. Then in 2017, we saw a 26% expansion in global liquidity. Bitcoin did a 20x in 9 months, rallied from 1,000 to 20,000. Then in 2020, depending upon how you measure it, we saw about a 40% expansion in global liquidity. Bitcoin pumped 600%. It pumped from just under 10K to 60K. But now what's really interesting, Bitcoin has already rallied from $16,000 to $108,000 at its peak, and global liquidity hasn't even moved. It's up by like 2% over the past 24 months, which is kind of what this chart here is measuring. Year-on-year change of global liquidity really hasn't budged that much at all. So I find it really interesting, Rob. A lot of people think Bitcoin's peaked. A lot of people think Bitcoin's topped. And I disagree with that. I feel like we're about to see global liquidity expanded in a pretty big way. I think after we see a lot of these tariff agreements, it's going to be the perfect opportunity for central banks to continue cutting rates, because they're already cutting rates today. But I think rates will be aggressively dropped, and that's when the money printers will get turned on. But I'd love your thoughts on that whole thesis.
Yeah, this whole bull run, these last 2 years of over 100% growth in Bitcoin, has not been accompanied with the classic money printing or liquidity surge that we've seen in prior bull runs, right? So we have been lucky, I guess, in that regard, that Bitcoin's been able to grow so substantially without the massive money printing, and that can be obviously pointed towards the fact that there's been massive institutional adoption, right? From the BlackRocks to the ETFs to the MicroStrategies, all these giant institutions buying up the Bitcoin has allowed for the Bitcoin price to run up without the fact that the central bankers haven't had the money printers on, at least not to the effect that they have been in prior cycles. So we're set up and we're sitting pretty, and we're sort of on this ledge that just needs that final ingredient, right? We just need that final spark, which is central bank liquidity. And we saw that today. What happened? The Chinese yuan was weakened to its lowest point against the dollar that it's been in the last 5+ years, breaking through a major level that it's been hitting against multiple times since 2020. So it's now at 7.33, 7.35 yuan per dollar. So yeah, I think that looks like it's about to blow. So this leads me into my wider point of what I think is really going on here. So when Trump first unleashed these tariffs, he brought out this board with all these numbers saying China has 80% tariffs on us, so we're going to give them 40% tariffs. EU has 40% tariffs on us, so we're going to give them 20%. And all these numbers seem sort of arbitrary, right? It included this McDonald Island or whatever that only has penguins on it. Why are we putting tariffs on an island that only has penguins on it? Well, it seems as if this week has gone on and other countries around the world like Vietnam, Cambodia, they're all coming to the table saying, please give us a break. We'll do whatever you want. We'll eliminate all tariffs. And Trump is refusing those. It doesn't seem as if that those tariffs that he brought out on that big board were the main goal. I think what really is going on here is a war. This is a preemptive strike against China. I did see a leaked report that Hegseth, the Secretary of Defense, had prompted and prepped all of his people on a potential invasion of Taiwan. So say the Trump admin had gotten clear intelligence that China was about to go all in on Taiwan. Well, they would sort of back out of Ukraine, right? Like not want to deal with that. They would let the Middle East just do whatever the Middle East does and focus their energy on what's going on in Taiwan, because we all know that Taiwan and its creation of semiconductors and the chips that are needed to produce this AI revolution, it all centers on this one little magical island in the Pacific Ocean that is a stone's throw away from China, but close to America in its cultural affiliation or whatever. So if they had gotten word that China was about to make a move on Taiwan, again, also look at where China is right now in terms of its demographics, right? I mean, this is the last time that they'll have a really large fat band of people between the ages of 20 and 30. Their demographics look horrible.